Good morning. Welcome to your daily solo 401k webinar Q&A session with my solo 401k financial. We try to help you stop overpaying taxes by utilizing tax shelter retirement accounts to build real retirement wealth. Today's topic is the Roth Trifecta. So you're going to be able to perform the Roth Trifecta. We're going to discuss that, where you can make mega backdoor Roth solo 401k contributions, the mega backdoor Roth 401k contribution, and the backdoor Roth IRA contribution, also known as the Trifecta Roth strategies. So we use these daily webinars to cover certain topics and also to answer questions, whether it's regarding IRAs or 401k plans. We are well versed on both. So this is your chance to get answers. Go ahead and use the chat to ask questions. Type them over now, and then we'll get to them as we cover today's topic. I don't see any questions at the moment, so let's get started here. So again, what if I told you that in one single year, you could legally contribute more than $100,000 into your retirement accounts combined, all as Roth funds, by utilizing both the backdoor Roth IRA strategy, the mega backdoor Roth solo 401k strategy, and the mega backdoor Roth 401k strategy. And this would result in tax-free money forever, using these three different Roth strategies at the same time in the same year. So today's webinar, we're going to break down what we like to call the Roth Trifecta. So again, if you have any questions, go ahead and type those over, and then we'll pause and answer those questions as they come in. So with the Roth Trifecta, high-income professionals with multiple income streams often assume they must choose between Roth strategies. Well, in reality, the IRS allows a powerful combination. This is often referred to as the Roth Trifecta. That basically the Roth Trifecta allows individual and eligible taxpayers to fund three separate Roth pipelines in the same year. Yes, you heard that correctly, and we're going to be unpacking that right now. So there's the mega backdoor Roth solo 401k, the mega backdoor Roth through a full-time employer, and then the backdoor Roth IRA. Now, before we get to these strategies, it's important to understand that in order to open a solo 401k plan, you need to be self-employed. Obviously, if you're not self-employed, that equals no solo 401k plan, and therefore no backdoor Roth solo 401k strategy. The eligibility requirements for a solo 401k plan is that you are self-employed. That is, you have an owner-only business, whether it's a sole proprietorship, partnership, S corporation, LLC, tax, or any of the above. And your business cannot employ any non-owner full-time W-2 employees who work 1,000 hours or more in your business. So as long as you do not employ a W-2 employee who is not an owner in your business, who does not work 1,000 hours or more, then you would qualify to open a solo 401k plan. You can always exclude those who are under age 21, regardless of how many hours they work. So if you hire a W-2 employee who's under age 21, you can still exclude that individual, even if that individual works over 1,000 hours, 1,000 hours or more in the business, because you can always exclude those who are under age 21. Similarly, you can always exclude any contractors that you hire for your business. Of course, if you're a contractor, you're self-employed, so you would qualify. But if you were to hire contractors for your business, you can exclude those contractors because you're not required to offer the plan to those who are contractors in your business. So let's talk about how the Roth Trifecta works together. I see some questions here. We'll get to those in a little bit. All right. So when structured correctly, these strategies can coexist without violating contribution limits or IRS aggregation rules. So let's break down how each works and how they fit together in the same tax year. Let's talk about the backdoor Roth IRA first. So with the backdoor Roth IRA, there's a two-step strategy used by individuals whose income exceeds the Roth IRA income limits. Because keep in mind that when you want to make a contribution to a Roth IRA, if your modified adjusted gross income is too high, you cannot make a Roth IRA contribution. That's where the backdoor Roth IRA comes into play. So, for example, for tax year 2026, the modified adjusted gross income is $252,000, which means that if your modified adjusted gross income is greater than $252,000 for tax year 2026, you cannot make a Roth IRA contribution. However, again, this is where the backdoor Roth IRA comes into play, because you can make non-deductible IRA contributions regardless if your modified adjusted gross income is greater than $252,000 or even less. So when you make a non-deductible IRA contribution, you're going to make it to an IRA. Once you make that that non-deductible IRA contribution to your IRA, you can then convert that non-deductible IRA contribution to a Roth IRA. So that's the first leg of the Roth Trifecta. Now, key IRS rules to understand when performing the backdoor Roth IRA is you need to make sure that the annual contribution limits are satisfied. For tax year 2025, the IRA contribution limit is $7,000. It increased to $7,500 for tax year 2026. Of course, you can also do a catch-up contribution as part of the non-deductible IRA and then convert that over to the Roth IRA once you make it to the non-deductible IRA. Let's keep going here. And then again, we'll take a look at some of these questions here in a moment. Now, the backdoor Roth IRA strategy works best when you have no other pre-tax IRA balances. Because if you have other balances in your IRAs, then that's going to impact your backdoor Roth IRA conversion. So, on a side note, if you do have other IRAs, you can actually transfer those IRAs to the solo 401k. So those pre-tax IRA funds to the solo 401k, so that you can isolate your non-deductible IRA so that you can perform that backdoor Roth IRA calculation. Lastly, the backdoor Roth IRA is governed by the IRA regulations. They're not impacted by employer plan regulations. Therefore, the solo 401k rules and the full-time employer 401k rules do not impact your ability to perform a backdoor Roth IRA. Those are all impacted by the IRA regulations. So why is the backdoor Roth IRA not impacted by 401k contributions? Well, number one, a 401k is not an IRA. An IRA stands for an individual retirement account. Whereas 401ks, you have to be self-employed or be working for a business that offers a 401k. So for example, if you want to contribute to a solo 401k plan, you have to be self-employed because the plan is sponsored by the self-employed business. Similarly, if you want to contribute to a 401k, a full-time employer 401k, you would work for an employer. That employer would need to sponsor a 401k. So again, contributions to your solo 401k or your full-time employer 401k do not reduce or eliminate your ability to do a backdoor Roth IRA. So they have separate contribution rules. Also, 401k balances are not counted under the IRA pro rata rule. So when you're processing a mega backdoor Roth solo 401k conversion, or a full-time employer mega backdoor Roth 401k conversion, those are not subject to the pro rata rules. IRAs have their own pro rata rules, and that's why I mentioned earlier that if you have other IRA funds, you would want to transfer those pre-tax IRA funds to the solo 401k to isolate your non-deductible IRA funds so that you could then perform that backdoor Roth IRA. So this means that you can still maximize your solo 401k contributions, your daytime employer 401k contributions, your non-deductible IRA contributions as part of the backdoor Roth IRA. So let's talk about participating in both a full-time employer 401k plan and a solo 401k plan. Let me get to those slides here. Give me a moment, please, and we're going to take a look at some questions here in a moment. Okay, we're going to talk about the Mega Backdoor Roth Solo 401k as well as the Mega Backdoor Roth 401k. So many professionals earn income that is from two sources. For example, let's say you are a doctor or an attorney. A lot of those professionals tend to be high income earners. Let's say that you work for an employer as a W-2. You work for a full-time employer that offers a 401k. So that means you're receiving W-2 wages from that full-time employer. And also, let's say you're self-employed on the side. Let's say you also have a side consulting business. So you can sponsor so that side consulting business can sponsor a solo 401k. Which means that you're going to have earned income from self-employment, whether it's Schedule C, so 1099 income because your self-employed business is a sole proprietorship, or it could be an S corporation where you receive W-2 wages from your self-employed S corporation. So the IRS rules allow participation in both plans, in both the solo 401k plan and the full-time employer 401k simultaneously. Now that's allowed as long as contributions are sourced correctly. So contributions to your daytime employer 401k would be based on the W-2 wages from your daytime employer 401k, whereas contributions to your solo 401k plan would be based on your self-employment income from that side business. So your net self-employment income if we're talking about a sole proprietorship self-employed business, or if it's an S corporation self-employed business, it would be W-2 wages from that self-employed S corporation business. Now, it's important to understand that contributions must match the income source. That means that you can now fund a solo 401k using W-2 wages from your daytime job, and vice versa. You can now make contributions to your daytime job 401k based on your earned income from your self-employed business. So if you want to contribute to your solo 401k plan, those contributions have to be based on your earned income from your self-employed business. And if you want to contribute to your daytime employer 401k, you have to base that on your W-2 wages from your daytime employer 401k. So again, let's unpack the Mega Backdoor Roth Solo 401k as part of the trifecta. So, as I've touched on already, you need to make sure that you have a properly designed solo 401k plan that allows for voluntary after-tax solo 401k contributions, as well as end-plan Roth conversions, which means that those voluntary after-tax solo 401k funds can be converted to the Roth solo 401k designated account or to the Roth IRA. So by having a plan that allows for voluntary after-tax solo 401k contributions as well as end-plan conversions, that allows for the Mega Backdoor Roth Solo 401k strategy. Here at my Solo 401k Financial, we do provide a Solo 401k plan that allows for the Mega Backdoor Roth Solo 401k strategy. We offer a very robust Solo 401k plan that also allows for Solo 401k participant loans, where you can borrow 50% of your solo 401k balance. You can also invest in equities as well as private equity, hedge funds, cryptocurrency, precious metals, physical real estate, and so forth. It also comes with a $1,500 auto contribution credit, which is a way of the government essentially subsidizing the cost of maintaining the solo 401k plan for years to come. So again, the Mega Backdoor Roth Solo 401k enables large indirect Roth contributions based entirely on your net self-employment income from that self-employed business. And this is powerful because solo 401k plans are not limited by an employer's plan design, because you are the one who is self-employed and you're the trustee of the plan. So as long as you use a solo 401k provider like my Solo 401k Financial, we're going to draft that solo 401k plan with the maximum flexibility under the IRS regulations. So the plan can be customized to include the Mega Backdoor Roth feature. As a matter of fact, we draft all our solo 401k plans with the Mega Backdoor Roth features. And you're actually going to track those contributions to the solo 401k using separate holding accounts within the plan. Let me pull up so here's an example of the Mega Backdoor Roth Solo 401k strategy in action. So let's say your self-employed business is an S corporation. It could even be a sole proprietorship, but for illustration purposes, let's say it's an S corporation self-employed business. So the plan would be sponsored by that self-employed S corporation, which means that under that solo 401k plan, you're going to have what's referred to as 3 separate holding accounts, because the plan requires that you separately track your contribution sources. So here's an example of a one participant plan that's sponsored by your self-employed business. So the plan is a retirement trust. It's a separate legal entity, so it's going to have its own separate employer identification number. You do not use the EIN for your self-employed business for the solo 401k. The plan is a retirement trust, so it'll have its own separate EIN number. Let's say you have IRA funds that you want to isolate to perform the Backdoor Roth IRA. You could transfer the IRA funds to the pre-tax solo 401k holding account, and then you can make the voluntary after-tax solo 401k contribution. For example, for tax year 2025, the overall contribution limit is $70,000, and you still have time to open a solo 401k plan here in 2026 for 2025 so that you can make voluntary after-tax solo 401k contributions if you had earned income from self-employment income in 2025. So let's say you make the $70,000 contribution as a voluntary after-tax to the voluntary after-tax solo 401k holding account. So again, we would help you to open up 3 separate brokerage accounts to hold these different source of funds. It's just one plan, but 3 separate buckets to hold each source of funds. So the voluntary after-tax solo 401k contribution would flow into the brokerage account, aka holding account for the plan. And then from there, we get converted to the Roth Solo 401k plan, resulting in $70,000 in Roth Solo 401k funds for tax year 2025. For tax year 2026, you can do a $72,000 voluntary after-tax solo 401k contribution and convert that to the Roth Solo 401k. So the limits went up by $2,000. The annual limits for the Mega Backdoor Roth Solo 401k contribution amount. Once you contribute that amount to the voluntary after-tax solo 401k and it gets converted to the Roth Solo 401k, once it goes into the voluntary after-tax solo 401k bucket and then it gets converted to the Roth Solo 401k, you would complete our online conversion form found on the Forms tab of our website. That's how we collect the necessary information to issue a Form 1099-R to the IRS, which reports the Mega Backdoor Roth conversion. You're going to want to convert those funds right away so that there are little earnings. So as soon as you convert those voluntary after-tax solo 401k funds to the Roth Solo 401k, you're going to complete our online conversion form so that we can issue that Form 1099-R. The only amount that's going to be taxable when you convert that over to the Roth Solo 401k are the small earnings that accrued in that voluntary after-tax solo 401k holding account before it got converted to the Roth Solo 401k or even to a Roth IRA. This is an example of a 2-participant plan. So if you're self-employed in the same business, let's say you're married and both spouses are working under the same business, it would result in just one plan. So each of you could actually perform the Mega Backdoor Roth Solo 401k strategy separately. It'll be based on your respective earned income from self-employment activity in that business. And if you each have enough net self-employment income, you could each perform that Mega Backdoor Roth Solo 401k strategy. You'll each have separate holding accounts under the plan because the Solo 401k is a defined contribution plan requiring that both participants' funds and sources are separately tracked under the plan. And that's done by having separate participant accounts and holding accounts under that Solo 401k plan. So it's not 6 separate Solo 401k plans or 2 separate Solo 401k plans. It's one plan because the plan is sponsored by the business, but both of you, in this case, both spouses, are participants in the plan. Now let's talk about the Mega Backdoor Roth strategy, which is the third leg in what we like to call the Backdoor Roth Trifecta. So with the Mega Backdoor Roth 401k, so we're talking about through your full-time employer. So this is a 401k offered by your full-time employer. Now, some full-time employer plans, 401k plans that is, they allow for voluntary after-tax contributions, as well as in-plan Roth conversions or in-service rollovers. So you need to make sure that that employer offers a 401k that allows for the Mega Backdoor Roth 401k strategy. I know that the Amazon 401k allows for the Mega Backdoor Roth 401k strategy, for example, the Amazon Corporation. And I know that now with the Mega Backdoor Roth becoming more and more mainstream, a lot more full-time employers are allowing for the Mega Backdoor Roth 401k through a full-time employer plan. So this is commonly referred to as the mega backdoor Roth at work strategy. So it's a mega backdoor Roth 401k at your work, at your employer. Of course, again, not all employer plans allow for the mega backdoor Roth 401k. So your daytime employer 401k must explicitly permit voluntary after-tax contributions, as well as Roth conversion or in-service distributions. Without these features, the mega backdoor Roth 401k would not be available through that full-time employer. So check with your HR department. You can always ask for a copy of the summary plan description agreement for that daytime employer 401k, which summarizes all the features available within that full-time employer 401k. So that's how the mega Roth Trifecta works, where you utilize the backdoor Roth IRA, the mega backdoor Roth solo 401k, and the full-time employer mega backdoor Roth strategy. So again, let's learn about why these strategies do not interfere with each other. That is the ability to perform the backdoor Roth IRA, the mega backdoor Roth solo 401k, and the mega backdoor Roth 401k through work. So this is where a lot of people get confused. So the key is separate regulations, separate rules. So IRA limits are separate from 401k limits. Solo 401k limits are calculated independently from your employer 401k limits when we're referring to the mega backdoor Roth strategy that refers to making voluntary after-tax solo 401k contributions. In other words, after-tax contributions are never shared across unrelated 401k plans. In this particular example, your daytime employer 401k and the solo 401k plan for your self-employed business. So what does this mean in practice? Well, contributions to a daytime employer 401k do not reduce voluntary after-tax contributions to a solo 401k plan. So even if you maximize all your contributions to your daytime employer 401k, you're still going to be able to maximize your voluntary after-tax solo 401k contributions to your solo 401k plan based on your earned income from self-employment activity, thus allowing for the mega backdoor Roth solo 401k strategy. Also, contributions to a solo 401k do not reduce voluntary after-tax contributions to a full-time employer 401k. So neither plan affects your ability to complete a backdoor Roth IRA or the mega backdoor Roth solo 401k or the mega backdoor Roth 401k strategies. So each plan stands on its own as long as income sourcing and plan design rules are followed. So let's put this all together. So let's put the mega backdoor Roth trifecta together. So an eligible taxpayer can, in the same year, fund a backdoor Roth IRA, make mega backdoor Roth contributions through a full-time employer's 401k, process a mega backdoor Roth solo 401k using self-employment income. So this structure is going to allow you for massive Roth accumulation, as well as long-term tax-free growth. And you can also diversify across all three retirement accounts, the Roth IRA, the the solo 401k, and the full-time employer 401k. So the Roth trifecta is not a loophole. It's a result of separate sections of the tax code working together. So you got to make sure you have the necessary income sources. You got to make sure you've got the right 401k and solo 401k plan design. And you need to make sure that the contributions are tracked accurately. So high-income professionals can unlock one of the most aggressive Roth funding strategies available. So if you have both W-2 income and self-employment income, this is a planning opportunity worth exploring carefully with the right plan documents and the compliance support in place. Okay, let's pause there and take a look at some questions here. Here's a question. My wife has an LLC elected S Corp that I currently don't pay from. She has been using SEP IRA. Last year, I left my W-2 job to do consulting. I want to do a solo 401k. Can we be on the same plan even though we have two businesses with different tax entities, or do we need to separate solo 401ks? I'd like to open a solo 401k for 2025 and do employer profit sharing and after tax contributions. You would each need to have a separate solo 401k plan because you're both self-employed in separate businesses. So she would open a solo 401k plan sponsored by her LLC, and then you would open up your own solo 401k plan sponsored by your sole proprietorship. Contributions to her solo 401k plan would be based on her W-2 wages from that LLC taxed as an S corporation. Contributions to your solo 401k plan would be based on your line 31 Schedule C, which is the net self-employment income. That's the starting figure for solo 401k contributions for a self-employed business taxed as a sole proprietorship. Here's another question. What is the simplest way to make all Roth contributions in my solo 401k in the max overall limit of 72,000? The first 24,500 as an employee Roth contribution, and then after contributions, or skip employee contributions altogether. So when you make contributions to a solo 401k plan, you have a couple options. You can choose to solely make voluntary after-tax solo 401k contributions to the plan and therefore forego making Roth solo 401k contributions as well as pre-tax contributions. And the overall limit for tax year 2026 from a contribution perspective is $72,000. So if you make enough net self-employment income from your self-employed business, you can contribute the entire $72,000 to the voluntary after-tax solo 401k plan. Excuse me, to the voluntary after-tax solo 401k holding account, and then turn around and convert that amount to the Roth solo 401k plan. Keep in mind that with the voluntary after-tax solo 401k contributions, you can only make the overall contribution limit to that voluntary after-tax solo 401k, meaning that you can now make catch-up contributions, so the age 50 or the super catch-up contribution for those ages 60 through 63. Those can never be made as voluntary after-tax solo 401k contributions. So that's one option. Another option is you can break up your contributions, meaning you can contribute some as employee contributions, and then the difference up to the overall limit as a voluntary after-tax solo 401k contribution, and then convert it to the Roth solo 401k plan. You just want to make sure that you do not go over the overall contribution limit for the year between employee contributions, employer contributions, as well as voluntary after-tax solo 401k contributions. So as an example on this slide here, you could choose to solely make voluntary after-tax solo 401k contributions for tax year 2026. So you would make that $72,000 year 2026 solo 401k contribution directly to the voluntary after-tax solo 401k bucket, and then convert it to the Roth solo 401k bucket, resulting in $72,000 in Roth solo 401k funds for tax year 2026. And then you would complete our online conversion form that can be located under the Forms tab. So that'll prompt us to issue a Form 1099-R to the IRS to report that conversion to the government. So here are the contribution limits for tax year 2026. Again, those catch-up contribution amounts of $8,000 for those age 50 and older or the super catch-up contribution for those ages 60 through 61, those can never be contributed to the voluntary after-tax solo 401k bucket. The maximum that you can contribute to the voluntary after-tax solo 401k bucket is the overall limit, which is $72,000 for tax year 2026. For tax year 2025, it's $70,000. And again, you can still contribute. You can still open a solo 401k plan here in 2026 for tax year 2025 so that you can make voluntary after-tax solo 401k contributions. You have until your business tax return due date plus timely filed extension to do so, as a matter of fact. Excuse me, I've been bothering a terrible cold here for the last week. So let's take a look at some more questions here. I have a Fidelity Solo 401k prototype brokerage plan. I would like to switch to a plan with my Solo 401k because your plan offers in-service rollovers to an IRA. I called Fidelity as I thought I needed to terminate my current plan, but they told me that I would need to amend my existing plan. Is that true? That's exactly right. That's called a restatement. And yes, we assist with restatements. As a matter of fact, we process multiple restatements every day, whether it's from an existing solo 401k plan at Fidelity, an existing solo 401k plan at Schwab, an existing solo 401k plan at Ascensus, an existing solo 401k plan at T. Rowe Price, Invesco, Wells Fargo, Chase, you name it. It's not uncommon to switch from one solo 401k provider to the other, especially for those who are trying to do unique tax strategies with their solo 401k plan. We actually have a really good page on our website that explains, and let me share that with you, that explains how to switch your existing solo 401k plan from Fidelity Investments to a solo 401k offered by my solo 401k financial. And again, that's known as a restatement in the industry. Let me share that page link with you. And the way it works at a high level is that we would draft new solo 401k plan documents and make sure to encompass language that allows for the mega backdoor Roth solo 401k strategy. We can even help you to open up brokerage accounts at Fidelity for the solo 401k offered by my solo 401k financial, because unlike other providers here at my solo 401k financial, we let you choose where to hold your funds at. And many of our clients like to use Fidelity, Schwab, their local bank, credit union, any brokerage firm that will hold the funds. For example, we have a lot of advisor clients. So we have a large institutional side of the business, and those advisors utilize our solo 401k, and they'll hold the funds for their clients' solo 401k through the broker dealer that they clear through. So we let you choose where to hold the funds at, and we'll take care of the compliance reporting, including the IRS plan updates. And let me share that link with you that's specific to how to restate an existing solo 401k at Fidelity to my solo 401k. So one option is we would restate that plan to our plan, so you would complete our online application so that we collect the necessary information to prepare those new plan documents. I just shared the link there regarding of how to switch from an existing plan, solo 401k at Fidelity, to one with my solo 401k financial. So if you decided that you still want to use Fidelity Investments to hold the funds for the solo 401k plan, we would help you to open up new brokerage accounts at Fidelity Investments for the solo 401k plan that we offer. And it's our plan that allows for the mega backdoor Roth solo 401k strategy. So even though Fidelity offers their own solo 401k plan, they also offer brokerage accounts for a solo 401k plan offered by my solo 401k financial. As a result, you'll be able to transfer that existing Fidelity solo 401k plan, including any equities or index funds or any investment holdings in kind without having to liquidate those positions over to the new solo 401k brokerage accounts offered by my solo 401k financial. So we would help you to open up 3 separate brokerage accounts at Fidelity for the solo 401k offered by my solo 401k financial. You would have a pre-tax solo 401k brokerage account, a Roth solo 401k brokerage account, and a voluntary after-tax solo 401k brokerage account. So it's just one plan, 3 separate brokerage accounts labeled in this fashion. Once Fidelity opens those 3 brokerage accounts, they'll send you an email letting you know when they're ready. We don't have access to your funds, so Fidelity will email you. You'll be able to log in to view those brokerage accounts. You're then going to go into that website. You're going to log into Fidelity's website. You're going to actually nickname these brokerage accounts. You're going to label the first one pre-tax, the second one Roth, and the third one after tax. That's how you know which brokerage account is for which source of funds. Then we'll help you to transfer that existing solo 401k plan internally over to the solo 401k by filling out Fidelity's internal transfer form. Going forward, we'll help you with the contribution calculations, how to perform the Mega Backdoor Roth Solo 401k strategy, and performing the 1099R reporting. Fidelity will not perform any of those functions because under this capacity, they would be simply serving as the depository taking institution, aka the custodian of the funds. Hopefully that answers that question. Let's see here. We have some more questions. Here's a question here. It's a follow-up question. Fidelity said that the suppression rule would not allow me to open a new solo 401k within 12 months of terminating my existing solo 401k plan. So I would need to do an amendment or restatement with my solo 401k. Yes, and I think I answered this question. That's why it needs to be done as a restatement. Your Fidelity there, when you use the word suppression, they're talking about the cooling off period, which was put in place by the government to keep individuals from churning 401k plans. And that would only apply if you were to actually close that solo 401k plan and you took a distribution from the plan, or if you transferred it to an IRA. Then you typically have to wait 12 months, hence why they call it a cooling off period. You have to wait 12 months before you can open another solo 401k plan. As a result, that's why it needs to be done as a restatement. And as I mentioned a couple times already, we process these restatements every day. Therefore, it's not going to trigger what's referred to as the successor plan rule, aka cooling off period, because you're not going to have to file a Form 1099R or a 5500 easy to close the plan because the plan is not closing. Instead, you're switching solo 401k providers from company A to company B. Okay. Here's a question here. I have a SEP IRA in 2025. Can I set up a solo 401k in 2026 for 2025 as well? You certainly can. The regulations allow you to have both a SEP IRA and a solo 401k plan at the same time. So yes, keep in mind that when you make contributions to both, you have to aggregate the annual contribution limit between the SEP IRA and the solo 401k plan. Also, a SEP IRA only allows for employer profit sharing contributions, whereas a solo 401k plan allows for both employer profit sharing contributions as well as employee contributions. That's why the solo 401k plan seems to be more popular than the SEP IRA because it's one-stop shop with the solo 401k plan, meaning you can make profit sharing contributions to the solo 401k. So you may want to consider actually closing that SEP IRA and transferring it to the solo 401k plan. Because again, a SEP IRA only allows for employer contributions, whereas a solo 401k plan allows for employer contributions and employee contributions. And again, you cannot double up on contributions. You're going to have to aggregate your contributions to the solo 401k plan with that SEP IRA. So you got to stay within that overall limit, which is $70,000 for tax year 2025 between the SEP IRA and the solo 401k plan. For 2026, the amount increased by $2,000 to $72,000. Okay, let's keep going here. Again, pardon here, I've been battling the flu here for the last couple weeks, and I'm finally getting over it. So, can a two-owner S corp with no other employees open a solo 401k, but only one of the owners participate and open up custodial accounts at the brokerage firm? Yes. So if you've got a self-employed S corporation where you got two owners who are owners and employees in the business, both are now required to contribute to the solo 401k plan. For example, one can contribute to the plan in 1 year, the other not, or they can both contribute in the same year. What is more, one can choose to make employee contributions, the other may choose to only make employer contributions, or vice versa, or one may contribute to the other to the plan and the other one doesn't want to contribute to the plan. Why? Because the solo 401k plan is not a traditional 401k, so it's not subject to the testing and the non-discrimination rules. That only applies to a traditional 401k, and that's one of the reasons that a lot of times those traditional 401k plans are drafted as safe harbor plans to try to mitigate having to apply the non-discrimination rules. While a solo 401k plan is for owner-only businesses, meaning that you cannot employ common law full-time W-2 employees who work full-time or long-term part-time. So that's why you're now required to have both owner employees contribute to the solo 401k plan. It doesn't impact the other one that contributes to the plan. So good question. We actually get that question probably a few times a year. For an S Corp, if a solo 401k is established in 2026, is it possible to make pre-tax contributions for tax year 2025? Yes, under certain circumstances. Let's pull up the slides on that. So here's a good slide here that talks about who can fund in 2026 for 2025. It should actually say who can open a solo 401k plan in 2026 and make tax year 2025 contributions. But let's skip to your particular question here. Since yours deals with an S corporation, give me a moment here. So for tax year 2025, you can open a solo 401k plan here in 2026 and make certain contribution types. Specifically, the slide is a little, let me fix the slide here. Looks like one of the slides is missing. So specifically, oh, here it is. It's right above here. So if you open a solo 401k plan here in 2026, meaning that you don't currently have a solo 401k plan that you're restating from another company to our plan services, but you're actually opening one up for the very first time, then you have until March 15 of 2026 this year to open that solo 401k plan for your self-employed S corporation, and you're going to be able to make both employer profit sharing contributions as well as voluntary after-tax solo 401k contributions. However, you will not be able to make employee contributions. You have to set up the plan by December 31st of 2025 in order to be able to make employee contributions for tax year 2025 here in 2026. So because if you did not open a solo 401k plan by December 31st of 2025, and you're opening it now in 2026, then you can open it by March 15 of 2026, or if you file for an 1120S business tax return extension, you're going to have an extra 6 months. You're going to have until September 15 of 2026 to make both employer profit sharing contributions, and voluntary after-tax solo 401k contributions for tax year 2025 based on your W-2 wages from your self-employed S corporation in 2025. Now, I know you're talking about an S corporation, but if your business is a sole proprietorship, the rules are more favorable for you. So if your business is taxed as a sole proprietorship, you're going to be able to open a solo 401k plan here in 2026, and you can make employee contributions, employer profit sharing contributions, and voluntary after-tax solo 401k contributions for tax year 2025 by April 15 of 2026. If you wait until after April 15 of 2026 to open the solo 401k plan, but you open it by October 15 of 2026, so that means you filed a personal tax return extension for your sole proprietorship. Then by October 15 of 2026, you can make employer profit sharing contributions and voluntary after-tax solo 401k contributions, but not employee contributions for tax year 2025. Those have to be made by April 15 of 2026 for 2025 if you're opening the solo 401k plan for the first time here in 2026. Now, it's important to clarify that for those that already have a solo 401k plan, or they opened the solo 401k plan by December 31st of 2025, you have until your business tax return due date plus timely filed extension here in 2026 to make all contribution types, that is employee contributions, employer profit sharing contributions, and voluntary after-tax solo 401k contributions to your solo 401k plan, regardless if your business is taxed as an S corporation, partnership, or sole proprietorship. So don't confuse those rules. Secure Act 2.0 kind of muddied up the waters regarding the solo 401k adoption deadline, which is now driven by contribution type and entity type. Okay, we're about to come to the end of our session here. Now, keep in mind that we'll be going live again here in a couple hours. So if you don't have time to ask your questions now, you can ask them at that time. Now, if you're finding this information helpful, we would really like if you subscribe to our YouTube channel, like today's video right there on YouTube. Subscribe again to our YouTube channel, like us across the social platforms. That'll really help us get the word out to other solopreneurs about the Roth Trifecta, and also just about solo 401k rules and IRA rules in general. And also, if you subscribe to our channel, it tells the platform that you find this information helpful, and you're also going to receive notifications regarding when we go live. But again, we typically go live at least once a day, many times twice a day. We'll be going live again here in a few hours. In the meantime, let's look at some more questions here. I have W-2 income from my wife's LLC, but it's also a separate sole proprietorship. Will my after-tax contribution limits per planned company combine $72,000? So yes, your contributions to your solo 401k plan are going to be based on your sole proprietorship, and if you have enough self-employment income from that sole proprietorship, you can contribute $72,000 to the voluntary after-tax solo 401k plan and convert that to the Roth solo 401k. Your spouse's contributions would be based on her own W-2 wages from her own self-employed S corporation or LLC tax as an S corporation. So as long as she reports enough W-2 wages, she can also contribute $72,000 to her solo 401k and then convert that to the Roth solo 401k as part of the Mega Backdoor Roth solo 401k strategy. Follow up to the SEP IRA and solo 401k in the same year. If you maxed out the SEP IRA for 2025, can you still do employer profit sharing on the solo 401k, or is the limit 25% aggregated? It's aggregated. So if you've already maxed out your profit sharing contribution to your SEP IRA, you're not going to be able to make any more profit sharing contributions to your solo 401k plan because they're aggregated up to the overall limit. Following up on my SIP IRA. Now, keep in mind, we've performed probably 5 to 8 separate webinars on the difference and similarities between a SIP IRA and a solo 401k and why one is better than the other. If you go to our YouTube channel where we have over 1,100 videos, you can dig up several of those webinars and really take it all in. Here's a question following up on my SIP IRA and solo 401k question. I asked Fidelity, our SIP IRA broker. They said I can only have one plan, either a SIP IRA or solo 401k for 2025. Well, that's why you probably want to switch out of Fidelity if Fidelity is not willing to provide you with a SIP IRA and a solo 401k plan, because the regulations do allow you to have both a SIP IRA and a solo 401k plan in the same year. Okay. Oh, thanks for that feedback. All right, everybody, that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so that we can keep building this great community. We'll be back here again in a couple hours with more great content. Until then, have a good rest of the day.